All right.
We are. All right. Hello, everybody. We are live today, our Thursday live. As usual, we go live on Thursdays. And today we are so excited to discuss a topic that is very, very important, as well as very near and dear to many of your hearts. So today we will be talking about how to be an effective passive investor. Before that, let me introduce myself. My name is Tom Bibby Varghese. I am a digital marketing entrepreneur. I have a digital marketing company as well as a couple other companies. And I've been investing in real estate for the past 3 years. Currently, I started with 6 units, currently invested in about 1,800 units as a passive investor, as well as an active investor. So I'm very excited about this topic, right? So I can share what I learned, as well as what we have learned from different masterminds and stuff that we are part of. So with that said, let me turn it over to Noel, who's going to do the intro and talk about the topic as well.
Hey, thank you, Tom. That was great. And for all our new members, very, very welcome. Wish you all the best. You guys have any questions, hit us up. You know, we are available. I just wanted to just give you guys a warm welcome first to the group. And my name is Dr. Noel Liu. I'm a general dentist. I'm based off in Peoria, Illinois. We have a few locations and we operate general dentistry with a team of providers, and we provide value to our patients, our team, as well as real estate. So with that being said, like Tom said, let's kick it off today with how to be an efficient and effective passive investor, in a sense that how do you know which deal is good? What do you look for in an OM? How to do a due diligence, which is the most important aspect, guys. Because if you know your deal, you know your sponsor, you know the deal structure, the location, that can tell you a whole lot if that is a good deal for you to invest in or not. So Tom, with that being said, what will be the first criteria, you know, somebody looking at, and how would they get presented with a deal?
Yeah, I mean, first of all, I know a lot of people are looking for passive investment opportunities, right? Quickly, I think we should mention why passive investing is a great idea,
Yeah,
because you don't
excellent.
have to worry about collecting the rent, managing the property, finding the deal, putting it under contract, doing the due diligence, all that stuff that goes with being an active investor, then making sure the property is performing. As a passive investor, you just invest the money and enjoy the returns and the appreciation of the property. That's the beauty of being a passive investor, right? So,
Yeah.
so today's topic, how to be an efficient passive investor. I would say, Noel, the first thing is the deal itself, right? Without the deal, no investment, the investment won't make sense. What do you think?
Mm-hmm. Absolutely, absolutely. You know, where's the deal? How many units? Why is it on sale? Where is it located? What is the class of the unit? What is the class of the deal? Is it class A, B, or C? And we kind of touched on it in few of our past posts, like what each class means. And at the end of the day, if the deal doesn't make any sense and where the numbers are, it doesn't really matter what you're going to invest in. So the deal has to make sense. And how to structure the deal and how to put the numbers together so that the deal makes sense, unlike stocks where everything's speculation. So in real estate, there's a lot of variables that we can actually control and kind of project the outcome of what the deal is going to perform and how it's going to perform. So with that being said, Tom, today we're going to hit on 3 aspects, right?
Yep.
We'll hit on the deal itself, like you just mentioned. We'll hit on the deal structure. How is it structured? So when we are talking about deal structure, we are talking about like the business plan. What is the holding period? What is the management plan like? And then we'll lastly, but the most important part is we'll talk about the sponsors. Who are the sponsors and how do we do a due diligence? So the 3 aspects, the deal itself.
Noel, did you want to touch on that sponsors? What do you mean by a sponsor? I'm just making it like a little bit dumb.
Oh, yeah.
The new people who have joined newly.
Absolutely. Yeah, sorry about that. So here what I mean by sponsors is the people in the group who is responsible and who are involved in putting the deal together and basically projecting what the deal is going to be performing like and what is it going to be looking at 3 to 5 years from now. So these guys are the asset management guys. It could be guys who's signing off on the loan. There could be the guy who's sourcing the deal. So it's all a teamwork. And when we talk about sponsors, we are talking about general partners, the guys who are actually putting everything together for the passive investor.
Yeah, exactly. So basically the main guys who bring the deal together, right? The guy who says, hey man, I found a deal. I want some passive invest. That's what you're talking about.
Right.
Yeah,
Absolutely. Absolutely. So without further ado, let's start with the deal itself.
Okay.
So when we are talking about the deal itself, let's talk about the number of doors, Tom. How important is the number of doors to scale and to make sure the return is going to make sense?
Yeah, that's a great point, actually. A lot of people think when it comes to investing in multifamily properties, they look at, so many other numbers, the NOI, all that stuff, but they kind of neglect this one important number. In fact, this is the most important number, according to one of our mentors, is that the number of doors. Rather than buy a duplex or a fourplex, you got to buy at least 36, 32 unit, 36 unit, because without that, there is not enough money coming in to scale this business. So
Absolutely.
The number of doors, super important. That is, in fact, the most important thing you got to look at as a passive investor.
For sure, 100%. And then right after that would be, where is the deal located? For us, it's always, it has always been the Sunbelt states. It has always been like one of those growing areas where there's increased population. Despite right now with everything that's going on with the interest rates, those areas are still hot. Now, not saying like every real estate is equal, because they're not. Not all real estates are equal, but we got to find the hot pockets where the growth is happening.
Right. So Noel,
yeah.
you're mentioning about the market. Can you explain also again what Sunbelt means to all the to some of the people who may not understand?
Yeah, it's basically like the Sunbelt is like a little smiley face, right? Like at the southern states. And what are they? I'll give a few examples: North Carolina, South Carolina, Georgia, Tennessee, Alabama, Texas, Arizona, Florida. So yeah, these are the states where it's hot. And it's been like super hot after COVID.
It's literally hot.
Yeah, it's literally hot in a literal sense, and it's hot in a sense of migration and growth, right?
Yeah.
So these are the areas where the investment should be. Now, when we talk about real estate, we are kind of focused into multifamily. Now, there are many other aspects of real estate. There is a mobile home park, then there's storage, then there is industrial, there's retail space, office space, and we all know what's happening to the office space. Dying.
Yep.
Right.
It's getting decimated.
These office spaces are being reconverted and repurposed to become multifamily.
Yeah.
So we can see a trend that's going on. But at the end of the day, if you are invested in a cash flowing, like multifamily, because multifamily is one of the essentials, food, water, and shelter. So shelter being one of the essentials, it will always be fine, provided that the due diligence has been done, it's in the right location, and the deal itself makes sense.
Right. So you touched on the market, which is the Sunbelt states, and the location, meaning like a block could make a difference, right? So you want to be in the right place, right? What do you think about that? The location, how important is a location, like being in the right location?
Nowadays they have those demographics where they have heat maps, and it's pretty cool, where it kind of shows you where exactly the hot growing or the areas are with how much percentage. So right now the national average for a growth rate is about 1.1%. So when we are talking about like a block, right? So let's say, for example, Tennessee. So Tennessee, we know there are a lot of areas. Not all Tennessee are doing good, right? But there are areas where it's really, really hot. And
like name a couple of them. I know you were looking at some property over there.
Absolutely. Yeah. So I was looking into Franklin, Tennessee. I was looking into Spring Hill, Tennessee, and these are all one of the burbs of Nashville. So if you look at Tennessee, like in those areas, that growth rate is like 10-12%. I mean, almost 3 times the national average. But if you look at areas like Murfreesboro, I mean, that is like around maybe a 4 or 5% average. And if you look a slightly outside Murfreesboro, then it comes down to like a 2% or a 1.2%. So it all depends on where in Tennessee, but overall on a general geographical area, it's growing. Cool. So that is where the demographics really make sense. So like Tom was just saying, in Murfreesboro as well, if you have one area that's like 4.5 or 5% growth, right in the next 2 or 3 blocks you drive down, it's like down to 1.5 or 2%. So
And then
location,
crime, different factors, right? Could be the
oh
crime, it
yes,
could be demographics, many other factors also influence.
yeah,
So location, super,
foremost.
super important. Yeah.
So long story short, is it a class A, B, or C? A is like the best areas. So A would be defined as being next to Starbucks, Whole Foods, and you have like major malls, like major high-end stores, right? So that would be a class A. All brick, all stucco kind of finishes, and excellent landscaping. Class B would be kind of like a little bit downgraded, but it's a very, very decent property. And then of course, class C would be like, the crime rate is maybe a little bit higher. The cap rates are higher because the valuation is lower. So like more like a lower middle class, right, Tom?
Yep, absolutely. Here's a tip while he was saying that if you find a property near Starbucks or Whole Foods, you can just almost buy it eyes closed because they have already done the research and made sure that
Yeah.
their target market, like who's shopping at Whole Foods, they're not going to put it in a bad area. They'll
No,
always put
absolutely
it in a
not.
great.
Absolutely not.
So if you have a Whole Foods or Starbucks close by, it's almost a done
So,
deal. So
I know we spent quite a few minutes here on location because that is like the most important thing. And we can change a lot of things in a property, but one thing we cannot change is the location. And I know Tom keeps saying that all the time. So location cannot be changed. The second thing would be, what is the business plan for those guys too, for the location? What are they planning to do with the location? But we'll touch more on that when we are doing the sponsors, but the location is the utmost, like hands down the best area that, not the area, but the best parameter that you can look at in terms of deal itself.
absolutely.
So next thing I would like to touch base on is a little bit about the deal structure itself. So let's talk about the deal structure. When we are talking about the deal structure, it's got to do with the sponsors, right? So we have to understand like what the business plan is, how they're going to structure the deal. So when we were talking about the GP and the LP split, right, Tom? So explain a little bit about the split. So we see like sometimes it's a 30, 70, we see 80, 20. So just kind of touch base on that a little.
Yeah. So what Noel is saying is, so when in these deals, right? So the guy who is bringing the deal or the group that is bringing the deal to you, they're doing all the work, right? They're finding the property, putting it under contract, negotiating the deal, negotiating the debt, finding the equity, signing on the loan, putting the earnest money to put. There's a lot of work. Then they got to manage it, make sure it works. So they gotta get compensated, right? And then it's a good thing. They should be compensated pretty well because otherwise they're not going to take care of the property. So a lot of people get hung up on, oh man, how much is their percentage? How much am I getting? You don't need to worry about it. As long as your goals are being met, you're good to go. So what he's saying is, in these deals, right? So the GPs will say, okay, we are going to split the profits 80% to you, the LPs, limited partners, the passive investors, and we're going to keep 20%. Some will say it's going to be 70% be distributed. We'll keep 30%. Okay. So that's what Noel is talking about. But the thing is not to get too bogged down by what percentage they're keeping. You need to look at, is it aligning with your goals? Am I making this much return on my money? And is that my goal? That's all you got to worry about. So that's what Noel's talking about, the GP LP split. Every one of these deals is going to have some kind of split. So that's really the incentive for them to manage the deal, run the deal properly and all that.
Perfect.
Is that right? What did I miss, Noel?
Absolutely. You nailed it right on the head. And that's exactly what it is. You just have to make sure like whatever the money that an LP is going to be investing, what is a return on that capital and of the capital? So those are the two important aspects. And after that, everything else, you can break it down into a much more granular detail. But just from a high level point of view, we just need to understand there's a split. Majority of the split goes to the limited partners, which are the passive investors, and a small portion will go to the general partners. When we talk about a deal structure, we need to talk about financials. We need to talk about financial analysis. We need to worry about what is the financial of the property looking like, right? What is the vacancy of that property right now?
Yep.
What is going to be the debt structure? So that is one of the huge aspects that, in my opinion, is one of the most important parameters. It's what is the debt? So when we talk about debt, what are we talking about is basically loan from the bank. How much equity down payment are we going to be putting in? And what is the deal? What does the term sheet look like for that deal?
Yep.
So Tom, you want to explain a little bit about the term sheet? Like, what are we talking about when we talk about like we are going to be structuring a new debt, a bridge loan? Just kind of touch base a little bit.
Yeah,
And
let's
traditional
touch base
loan.
on that a little bit and
Yeah.
then keep it a little bit high level. So
Yeah.
for the new investors who are starting out, you just need to know certain things, right? So first of all, let's say you found somebody's bringing a property to you and the property is worth 10 million bucks. In other words, that's the total price of the property, right? So that 10 million bucks, and usually in a regular scenario, you could get financing for up to 80% of the value of the property. So it's 10 million, so 8 million, right? You can take debt on 8 million. Let's bring it down to 70%, okay, for to make it easy. So 7 million, you're going to go to the bank and get debt on that. And the bank's going to say, this is a term. It's going to be a 10-year interest-only payment, and it's going to be 5%. So that's going to be the term sheet and all that's detailed. So that's basically what the debt structure is. And the bank will be like, you got to bring the remaining 30% to the table. We will give you the 70%. And that 30% is actually what the passive investors are bringing to the table. They are the ones putting that 30% in. And the rest 70% is actually financed by the bank. And it could be, there's a couple things to watch out for, is like, it could be a fixed debt, meaning like the interest percentage, 5%, won't change for 10 years.
Yep.
Or it could be like, it's floating debt, which means that, okay, first 2 years, it's going to be fixed. And after 2 years, it's going to be floating based on what the treasury rates and all that stuff is going to be. So that's basically what the debt is. But you got to understand that all these properties involve debt, and debt on these properties is not a bad thing. Not all debt is bad. This debt is actually allowing you to buy these properties, leverage debt to buy bigger properties and take the appreciation and not having to share it with the bank. What do you
Yeah,
think
that's
more
great.
about that?
That's great. That's great. That's great. One thing I just want to stress out on something Tom just said, like the 30% that the LPs or the limited partners are bringing in, the general partners oftentimes are also limited partners invested in a deal. So like Tom
Great
and I, we
point.
have deals. So we are general partners. So we have a small percentage in the general partner deal, but we also have our own money invested as an LP, like a limited partner as well. And of
Yep.
course, with the general partner, they really have to put up all the escrow money, all the down payment, all the attorney fees, the CPA fees, everything is added. So the term sheet looks pretty much like how we operate. For example, all the dentists out there, like how do you get a loan and what the term sheet looks like, right? It's about the term, the duration, the interest rate, the payment, and all that good stuff there. So it's all like pretty much the same thing. And that's what it looks like. Now, one thing also we have to kind of worry about in the deal structure is what is the annual rents going to be looking like when it goes up? Where is the pro forma coming from? When we say pro forma, we mean like what is a projection coming from? Where are they getting the information from? What is the comps in that area? Meaning like what is the actual rents in that area? The best way to do that is call the areas, call the adjacent apartments, speak to the management. Just go like, hey, you know what? I move in this area. I'm looking for a 1-bedroom or 2-bedroom. What's the availability? And if they tell you the availability is, it's like, like almost 4 or 5 weeks out, it's a good sign, right? Or if they tell you like sometimes even in some cases, it'll be a 6 months out. Or they'll tell you like what the rent is right now currently. So that will give you an idea of what the rent should be. So these are just some of the little aspects that as a passive investor, you can do on your own side as in due diligence. And one more thing I would like to add up to is, a lot of times these guys will have like rehab replacement cost and everything. You don't really need to dive really deep in it, but just know that how is the rehab going to be paid, on that deal? Is it going to be financed, or is it going to be based on the equity raise or the down payment? So just some of the parameters to look out for. Other than that, look at the expenses, look at where the expenses are. I mean, if it's anything's over inflated, you want to make sure like, you keep them in check. We can always discuss more in detail about the actual numbers and some of the guidelines, but we're not going to dive into in this series. But some of those areas you can definitely look at where the expenses are, staff, like utilities. What else? What else is there? Like insurance, property taxes,
Yeah.
right?
Yeah.
And all the good stuff. And just look at the what you call it, the skill level. Like where are these guys getting all the numbers from? That is my most important thing.
Right.
It,
One of
yeah.
the things that you touched on, Noel, is very important. Like you said, hey, when they say, hey, the rents are averaging $1,200, we are expecting $1,200 rent on this property. What Noel was saying is the way to double check that is simply Google that property. And I think, what is it, rent.com or apartments.com? Go
Yeah,
there,
both those
put
locations.
put that zip code in, and make sure the property is comparable though. Like if they have a swimming pool, make sure you're looking at a property with a swimming pool, not like some rundown property, and
Right.
then call them and ask, or look at the rents. You can see the rents. And like you said, if you want to take it a step forward, just call them and they
Just
say,
call
hey
them.
man, we have a wait list, man. Then you know what? You should be like, that's great. I want to invest in this property. That's a good sign.
That's a
But
very good
it's
sign.
not always going to be like that. It's always there's like 10% vacancy and stuff, so.
Yeah, and then if you
Yeah.
guys understand cap rate, you want to make sure like when was the last time it was traded, how much was
Great
it, how much
point.
was the cap
Yeah.
rate then,
Yeah.
and how much is the cap rate today, and what is the projected cap rate in the future, because that will really affect the valuation of it. And then lastly, guys, just watch out for the underwriting. I always kept saying, like, if it's too aggressive or the returns are too good, it's a red flag. You should
Yeah.
just kind of watch out for those kind of things. Okay.
Yep.
And as a passive investor, Tom, what would you say? Like cash on cash and the total return is what matters, right? At the end of the day.
Yeah. And also, like you said, you touched on, I think we are going to talk about that in terms of, you said there's got to be a business plan. What are these guys going to do
Oh,
with the
yes.
property? So why don't you go ahead and get into that, and then we can talk about that.
Yeah, we spoke a little bit
So
about
the
the deal
third thing,
itself. We
right?
spoke a little bit about the deal structure, right?
Mhm.
One thing I would like to also know, one more part in the deal structure before we get on to that part is, we just want to make sure, like, how are they getting their investors? Because a lot of times when we get into these deals, we have to understand there's legal channels that we have to go through. And if there's a lot of documents to sign to get that investment done, that's a good sign. Okay, let's put it that way. Let's make it short, right? If there are no documents to sign, then it's not a good sign. Okay.
Yeah.
Yeah, because it all has to do with the SEC regulation, as well as the agreement, the legal documents that one has to go through to understand there's always risk and benefits in any kind of deal. So those are some of the deal structure that we would touch base on. So Tom, with your question, let's jump right into the deal sponsor. This is where the meat of the bone or the steak is, right? So let's talk about the deal sponsor. So for me, the deal sponsor needs to pass three things, right? The three things, what are they? Their professional character, their personal character, and their financial character.
I love it.
You want to dive?
Noel, did I lose you there? Noel. So he's saying the professional character, right? The first thing is they have to have a professional character, the deal sponsor. Okay. So what does he mean by that? The professional character, right? These guys are going to be your partners. So you got to really vet these guys. Okay. Vet meaning like the first one, again, like Noel said, the professional character. Oh, are you back, Noel? You
Yeah, I'm back.
froze
I'm
for a
back.
little
Sorry, I
bit.
had a
Okay.
little unstable
Yeah.
connection. Yeah.
So the professional character, right? That's the first point. So what he means by that? So let's say these guys should be accessible. Like if you have questions and if they don't have time to answer your questions, that's not a good sign. They should be able to answer any and every question you have. Okay. And like he said, the personal character, they should be honest. They should be forthcoming. They should be willing to tell you like it is. If they say, this is what we expect, and it may not happen like that. So very important, their personal character. Are they running a family properly? Stuff like that. Very important to me. I know, right? No, what do you think? What
Yeah,
else?
the best thing to do is just Google them, right? You see any
Yeah,
kind of red flags in Google, okay, avoid those guys.
yeah.
So with a professional character, what's the deal history? What's the track record? Who are they associated with? Very, very important.
Mhm.
And like Tom just mentioned, are they running any kind of business themselves? Right? Do they understand how to hire and fire people? Do they have a P&L of their own? Or even of the apartment complex they're operating? So I mean, either or, by the way, because a lot of the sponsors, they don't own businesses, but they are very good operators. So you kind of have to balance that out a little bit.
Yeah,
And then references. What are
yeah,
some of the references from past LPs or past deals that they did? Or maybe even a past general partner they partnered with? Just make sure like, hey, is this guy legit? Just kind of ask around and know around. And this is where it's so important to go and network into these events. And which is
mhm,
why this is one of the main reasons why I got into real estate and into all these groups, is because I need to know what the other guy's doing. Like, so
yeah,
this way, then if we have a partner, we are absolutely sure like this guy's legit. Now, that's not to say a deal cannot go bad. Absolutely. I mean, there's always risk, right? But
yep,
overall, on a general grand scheme of things, that GP partner or that person should be performing well, and they understand the metrics really, really well.
yep,
Okay.
yeah,
I would probably even take it a step forward and just see the question investor like, hey, what is the liquidity? What is the net worth? Stuff
yeah.
like that. That's a financial character. You
Hmm.
definitely want to make sure you ask,
You
because
you you were telling something very important, right? So they should have some business. They should be business
yeah.
savvy. If they run a business, and they know how to read a P&L, profit and loss statement,
Mhm.
they can run this. I mean, without a problem. I mean,
Just
it
like any
still
other
doesn't
business,
make
right?
them an
Yeah.
expert, but they still can handle it. But if they have no business experience, or they have never done an apartment, they've
Yep.
never successfully run one, I would have reservations about it. So that's a good point that you just said. No.
Yeah, and then
Yeah.
personally, what I like to do too is, if I'm looking at the deal, I would like to call the property management, or even like call the main sponsor, like who are the tenants, who rents this place,
Yeah.
because it's important. Like, are they professionals? Like, what is the average credit score in that apartment? What kind of profession are they in that apartment? What kind of work do they do in the apartment?
Yeah.
If you see like cars standing outside during the daytime, we got a problem,
Yep.
right? And if you see like empty parking lot during the daytime, but in the nighttime it gets filled, okay, that shows that all these guys are working.
Right.
What is a crime in that apartment or in that complex, in the history, or what is a crime in that location, right? What is the income
Right.
bracket like for these residents? What are they earning on an average, like a median income? And basically the tenant performance, are they paying their rents or not? So as a passive investor, you can do all these questions. You can definitely ask all these things here about the deal, because at the end of the day, it's your money that's going to be working for you. So you want to make sure that it's working hard and not working like, just sitting there.
Yeah.
And then of course, the business plan. The business plan is the utmost important thing. Like
Yeah.
what
Touch on that a little bit. Like, what do you mean by a business plan for an apartment building specifically? Like,
Yeah, so business plan, when we speak about Class B properties or Class C properties, what is their game plan there? Are they trying to convert all of them? They're trying to convert half of them? Is there rehab budget in process? Rehab. So talking about rehabs, one other thing a passive investor can do is, when they look at the underwriting, definitely want to make sure the rehab cost is north of 3,000 a unit. Anything less than 3,000 a unit, you need to ask the sponsor, like, why is it so low? Like, what's happening? Because anytime when you're doing one of those rehabs, so you have to kind of understand that dollar amount as well, because that's all comes back to the business plan. What is it? How much can they pour in to bump up the rents? Can they even bump up the rents? Right? If you look
yep.
at the comps, if the comps are like all stagnant and they're like right there with the rent, how likely are they able to bump up like $100 or $200 per unit? And what is the business plan going to be like in terms of rehab? Is it going to be substantially better than the comps to get it better so they could charge more rent? Um, Also for the outside, so we're talking about per unit. So let's talk about the outside, the common areas. What about landscaping, parking lot, like the sidings, the brick, the roof? What about all those structures? Are there any kind of deferred maintenance that needs to be taken care of that we need to tackle ASAP in the business plan? What about management company? Who are we going to hire? Is it going to be the deal sponsor doing the management? And if they
Very,
are,
very
their
important
track
point,
record,
actually. Yeah.
right?
Mhm.
What is their track record? What is the marketing budget? What is the marketing plan? How do you find, how would you guys, how would you get all the tenants to come back or let's say to stay back, lease renewals? So we can go on and on and on, but these are some of the stuff there. So just think about it. The property management, they are like your biggest piece of the puzzle right there. If you get a good one, everything falls right in place.
Yeah,
Right?
by the way, Noel, I just wanted to let everybody know if you have any questions, feel free to put it in the comments and we'd be happy to answer that. Okay. So
Yeah, absolutely. And then lastly, with the business plan too is what are the replacement reserves that are there and what is and how they're going to utilize it. And
yeah.
and at that time, the liquidity of the sponsors are very important because they need to understand, like, if anything is a little bit of a turbulence in terms of the business plan or the economy, those sponsors need to ensure that there's enough capital because the banks would require it.
Mhm.
The banks are not going to require to put it in an escrow, but they will require for the GPs to have it with them. But that is one of those things too, where as a passive, you need to ask those kind of, or have those in back of your mind to think about them. Because the GPs who are putting no money down in the deal and they're going in the deal and it's all passive investors, those are kind of the GPs. I personally think you should be like asking questions.
Yeah.
What do you think, Tom?
Yeah, 100%, man. 100%.
100%.
Yeah, 100%. You should be asking questions about that. In
If
fact,
they lose money, if you lose money, they should be losing money as well.
yeah, exactly.
Right? I mean, it's
Exactly.
only simple.
Great point. Yeah, exactly. I mean, we all have to have skin in the game, basically. So that's an amazing point that you just said. So I totally agree with that.
Yeah, I
Also,
mean,
guys,
I think we touched a lot of good stuff, like briefly, but like I said, this is not the exact list, and this can go on and on. We can be here for hours, right?
yeah.
But
Also, Noel, while you were talking, I just remembered that if anybody has any questions, not only you can put in the comments after the live is done, we still answer those. And if you have any detailed questions, you have any deals
yeah,
that you want us to take a look at, simply send us a DM. If you have any questions about any real estate related stuff, feel free to DM Noel or myself. We are always checking DMs and responding. Although we have busy schedules, we take the time out to make sure that the members in the group get value out of the group and that there is no expectation from you. We are not expecting anything in return. We just want to help you in your real estate journey. So I know Noel answers a lot of DMs, although he's super busy running several practices.
yeah.
I get DMs and I also respond to that. So feel free to
Same goes
DM
for
us,
you.
guys.
Yeah.
Yeah, I mean, we are just making ourselves available here. So hope we can help as many people as possible. And that's our ultimate goal, is to help you in your real estate investment journey.
What's funny? I just wanted to end with one note. Like, I had a podcast this afternoon, and the guy was like, "Hey, is there any? How would they reach you at?" I just gave out my cell number, right? He's like, "Are you sure?" I'm like, "Yeah, that's
That's awesome, man.
all right, cool.
Yeah, cool.
All
All
right,
right,
guys.
guys. So was fun today. How to be an effective and an efficient passive investor. Noel dropped a lot of nuggets today. So let's recap that real quick, Noel, before we get off the call. Let's go ahead and
Yeah,
recap it.
yeah. Let's do a recall. I think we ended pretty good. So half an hour, awesome. We're on the spot.
Yeah.
So yeah, let's look at the deal itself. Let's look at the location. Let's look at what's in there, what kind of class it is. Like Tom said, Starbucks and Whole Foods. That's what you want to be close to. The deal structure itself. How is it split into the GP? Who are the GPs? Who are the LPs? Who's putting money where? Who's looking for the deals? Who's signing on the deals? Who's signing on the loans? Who's on the hook on the loans and those kind of things. Like the business plan that we touched a little bit on. Then of course the sponsors. That is like my most important one. So the sponsors themselves.
Cool.
So know who you're investing with.
Right. So first is the deal, then the deal structure, then the deal sponsors, basically. So those are the three. Good, awesome. I love it, man.
Yeah, and lastly, just watch out. There's a lot of you guys are going to get hit with, like, emails, texts, spams that, hey, we got this deal opportunity, come on in, because we are dentists, we are doctors. You're going to get constant attacks.
Yeah.
Just know your game. That's it. Do your due diligence. You know,
Cool.
whoever you invest with, just make sure there's always a risk of losing everything. There's always a return. However, the risk of losing everything is very, very calculated and very, very rare in real estate, right? It's calculated. Everything is calculated, unlike stocks. So just know who the sponsors are, who the jockey is, right, Tom? So what do you say? What do you say in the last lead? You bet on
the jockey, not the horse.
not the horse. I love it. I love it. All right.
Awesome, guys. Thank you very much for joining us. We'll see you next week, same time, Thursday, same time, 5:30 p.m. Central. Have a great rest of the week, guys.
All right.
Bye.